As Eric mentioned, my name's Kelly Earle. I'm the Vice President of Communications for Skeena Resources, and Skeena is focused on the Golden Triangle of Northwest British Columbia. I'm sure this is a slide you've seen a lot of recently. There's a lot of action happening in the Golden Triangle. It's a very exciting place to be. We have 4 projects in the Golden Triangle. Spectrum GJ is a copper-gold porphyry project that we released a PEA on in April of last year. Porter, Idaho is a high-grade, past-producing silver asset, but the focus of my talk today is going to be Snip and Skeena Creek, which are both past-producing mines. So Snip, we own 100%, and Skeena Creek, we just signed an option deal with Barrick in December to acquire 100% interest. So as Eric mentioned, these are 2 mines that were in production in the 90s and early 2000s, and I'm going to show you why we think there's a lot of material left behind that wasn't economic at the time, but would be economic now. So Skeena's chairman, Ron Nedolitsky, is accredited with the discovery of both of these deposits, and he, along with our chief geologist, Ron Nichols, who's here with me today, they always thought, well, they knew that there was material that was there, a lot of gold mineralization that just wasn't economic in the 90s, and that's because of low gold prices and lack of infrastructure. And now we fast forward to new infrastructure and a higher gold price. There's a lot of material left behind at both of these deposits, and I'm going to take you through that. So the first thing I mentioned is the lack of infrastructure that was in the area when these mines were in production. So when Snip was in production, it was a fly-in, fly-out, all diesel operated. They took the concentrate out on a plane in the winter months and then on a hovercraft in the summer months, if you can believe it. And there was no road to site. So fast forward to now, you can see the Snip and Skeena Creek deposit on the bottom of the page. We've got Highway 37 and the Northwest transmission line that runs all the way up to Red Chris. And about 2 years ago, a Calgary oil and gas company built 3 hydroelectric facilities smack dab in the middle of Snip and Skeena Creek. So where there was no infrastructure before, we now have 4 cents a kilowatt hour power. There's a 17-kilometer gap to road and a hydroelectric facility to Snip. We're working on building that road with Seabridge, who owns the ground around us, so construction will start with that on that road this summer. And for Skeena Creek, there's a road all the way to site, and there's another hydroelectric facility that's now 7 kilometers away. So completely different infrastructure than when these mines were in production. Let's start with the Snip project. So we own this 100%. We acquired it outright from Barrick just at the end of July of last year. Produced 1.1 million ounces at an average grade of 27.5 grams per ton. Produced from 91 to 99. And if you think about gold back then, it started around 400, 450 and dropped down to below 300. The average price of gold was around $350 when this was in production, and that was reflected in the cutoff grade. When the mine started operating, it was a 12 gram per ton cutoff grade. By the time the mine closed, it was a 24 gram per ton cutoff grade, if you can believe it. So all the material that's left behind that was below that cutoff grade that wasn't economic then is economic now. So Skeena inherited a database of over 280,000 meters with over 8,400 meters of usable underground development. And in 2016, we completed a surface drill program, and that's because we weren't able to access the underground workings until the project was 100% ours. And I'm happy to report that as of December, we wrapped up our first underground drill program where we completed 8,600 meters with some excellent results. So this is going to give you kind of the lay of the land. The main area of mining is the Twin Zone, which is on the right-hand side. That's where the majority of the production came out, just over 700,000 ounces. And then on the left side, you can see Twin West, 10,000 tons came out of there. But our main focus is going to be the Twin Zone. So everything in gold is the stoped out areas. Everything in blue is all the material that's left behind right now that wasn't mined that's greater than 5 grams per ton. So we're looking at what can we do today with a 5 gram per ton cutoff. So I'm going to take you through 3 cross sections running from the west to the east, and then I'm also going to take you through an exciting new area that we've identified that we're calling the 200 footwall target. So this is the furthest west section, and our main focus has been in areas that are around the historic workings, and that's because we've got underground exploration drifts that we can drill from. It's easy access, they're short drill holes. So we've been focused on the left-hand side where you see the gray, that's all the stoped out areas, and the kind of gold extensional veins below is the areas we've been focusing in. But in addition to building out ounces close to historic productions where we see a pathway to well over 500,000 ounces, we're also looking at the exploration upside and the larger potential on the project. So aside from building out ounces close to historic production, we're looking at defining a new twin zone, if it were. So, and we've got some new indicators for this. One of the nice things about taking old data and remodeling them up into 3D, which they didn't have in the 90s, is you're able to look at it with new geological eyes. So we've discovered a 1997 drill hole that graded 45 grams per ton over 4 meters, and it ended in mineralization, if you can believe it. So that's what's highlighted there on the right. And we think, along with some other geological information, being a late-stage dike called the biotite spotted unit, you can see that in the blue, in the twin zone on the left, we're seeing the same kind of mineralization and the same kind of dike. Off on the far right, we're calling it the 200 footwall zone because it's 200 meters into the footwall. So the Snip deposit is a series of high-grade shear veins that run parallel to each other. So we're seeing exciting new evidence for a possible new shear zone 200 meters into the footwall that would be a twin or identical to the original twin zone. So, and this isn't an isolated area. If we go 200 meters further to the east, we see evidence for this 200 footwall structure again. So we did a surface drill program in 2016, as I mentioned, and we tapped into 16 grams per ton over 13.5 meters from surface. And that's because our geologists remembered a surface sample that ran 90 grams per ton back in the 80s, so they put a drill hole in under there. And sure enough, we tagged into some great mineralization. There's a handful of historic drill holes in that area that have also hit the same mineralization. And interestingly, the same biotite spotted unit was that marker unit that I was talking about. So in addition to continuing to drill off the near mine resources, we're also looking for an exciting new area that we think we've tagged into called the 200-foot zone. And just so you can see some examples of the mineralization that we have tagged into and what we've released, I'm just going to highlight some assays here for you. So 91.56 grams per ton over 3.82 meters. That's a result that we put out in December from our drill. We put it out in January from our drill program that wrapped up in December. There's another one, 35.49 grams over 4.35 meters. Another one, 19.2 grams over 11.85 meters. So we are starting to tag into some real mineralization that's, you know, near where the historic workings are, and we've got gaps that we have to fill in there. And along with that, we're also going to try and do more exploratory drilling in that 200 footwall zone that I mentioned. So that is Snip in a nutshell. And I'm quickly going to cover Skeena Creek as well. So this, we just signed an option deal with Barrick in December of this past year, produced 3.3 million ounces, 160 million ounces of silver. The grade was 45 grams per ton gold, over 2,000 grams per ton silver. It was the highest grade gold producer in the world when it was in production, and it ran from 94 to 2008. As with Snip, you need to think about what the price of gold was when this mine was in production. It was all diesel operated, and that was reflected in the cutoff grade, which ran from 12 to 15 grams per ton for mill ore. So half was mill ore and half was direct shipping ore. 12 to 15 grams per ton for mill ore, 30 gram per ton gold cutoff for direct shipping ore. So what could we do if we went back there now with a much lower cutoff grade, because we now have a hydroelectric facility with 4 cents a kilowatt hour power that's within 7 kilometers. So as with Snip, we inherited a very large historical database, over 700,000 meters of assay data, over 7,000 holes of drilling. So what we've done on this slide is model up all the material that's left behind in the ground right now, today, as we speak. So everything in gray is the workings or stoped out areas. Everything in gold is mineralizations that's greater than 3 grams per ton gold equivalent. That's what we'd be looking at using for a cutoff grade today. And you can see there's a significant amount of material that's left behind in the ground right now. So the areas we're focusing on are the 21A and the 21C zone, and that's because shallow ounces are cheap ounces. Interestingly, the 21A zone on the top right there is where the first ever drill hole went into the program. That's what started off all the bonanza that was Skeena Creek, but subsequent to that, they found the 21B zone, which was mined, so the 21A zone was left, and it was never mined. So when we acquired this project, we got a lot of feedback from shareholders, well, that they thought everything had been mined out. So we ran an internal scoping study to say, okay, what cutoff grade would you have needed in 2005? That's when the decision to shut the mine down was made. And how much material was left behind at 2005 gold prices? So you needed a 15 gram per ton gold equivalent cutoff in 2005 to be economic. So you can see all the gold that's left there that's greater than 15 gram per ton. It's very potty. They high graded out some of those areas in the 21C zone, but you can see that there's not a lot left behind. Let's fast forward to today. This is using a 3 gram per ton gold equivalent cutoff that I was mentioning, and you can see it lights up. There's a substantial amount of material that's left behind that was not economic when the mine was in production, but would be economic today. So I'm going to take you quickly through 2 cross sections, through the 21C zone and through the 21A zone. This is the 21C zone. It's got a 1 gram per ton gold indicator shell. That's the yellow there. I'm just going to highlight some of these intercepts for you. 11.4 grams per ton over 32 meters, 12 grams per ton over 24 meters, 17 grams per ton over 20 meters. This is material that's left in the ground today, and this is where we're going to be drilling this summer. Let's flip to the 21A zone. This is nearer to surface. They actually looked at open pit mining this back in the 2000s, but again, it was sub-economic then. Highlight some of these drill intercepts for you. 63 grams per ton over 34 meters, 55 grams per ton over 24 meters. This is material that's in the ground right now, and we will be duplicating results like this when we're drilling from here this summer. So exciting times ahead. So objectives for 2018 for Skeena. Snip is still our primary focus. We're further ahead with that. We want to do 15,000 meters and define the rest of the mineralization near mine, and also step out and look at those 200 footwall targets. For Skeena Creek, we're going to be drilling 5,000 meters. We have all the core left behind for Skeena Creek, so it should be fairly quickly that we can put everything that's left behind into a measured and indicated category. We also want to start geotechnical and metallurgical testing because we know it's a big question when it comes to Skeena Creek. And then just quickly, our capital structure. Skeena, our shareholders have been mostly institutional, and they've been wonderful supporters, but they don't help move your share price. So we've had a huge push lately to focus on retail. We did a share consolidation in October. Since then, we've had 3 newsletter writers pick us up. We completed an OTCQX listing. We're about to have a bank pick up coverage on us. So the momentum is definitely starting to pick up, and with the drill results that we should have coming out of Snip and Skeena Creek this summer, we think it's going to be a very good year for Skeena shareholders. Thank you.